and welcome to today's post-election tax update and fireside chat. My name is Jonathan Bloom, and I'm a partner and wealth advisor with AAF CPAs and AAF Wealth Management. Today, I'll be joined by my two partners, Rich and Josh. I'll let them introduce themselves.
Great. Thanks, John. My name is Rich Weiner, and I am a tax partner in our transaction advisory and commercial tax practices.
Thanks, Jonathan. My name's Josh England. I'm a tax attorney and partner here at AAF CPAs with our Trust and Estates Department.
Thanks, guys. Before we get started, for those CPAs joining us today, we will be offering one CPE credit for today's session. Please make sure to answer all the poll questions to ensure that you receive credit. So let's get started. What a wild couple of months we've had leading up to this election. Regardless of what side of the aisle you may fall, I'm sure we can agree that we're glad to no longer be seeing commercials or receive political phone calls, texts, or flyers for at least a year. That said, we do understand that politics is a hot button issue. Our goal today is to stay away from all social issues that so many of us are passionate about, and to focus purely on last week's, the financial impact of last week's elections. We do have a large group today, and we're going to cover a lot of topics. Some may apply to you and others may not, but hang on and we'll try and have some time to answer questions at the end of our time together today. Please feel free to leave questions in the chat and we can try to address them. So let's get right into it. Last week's election, Republicans won both the White House, the Senate, and likely the House of Representatives. Let's talk a bit about the potential red wave and how it could affect policy implementation moving forward. Josh and Rich, do you want to comment on the creation of new laws and what is needed to do so?
Sure. Good afternoon, everybody. The lawmaking process during the course of an election cycle, all the attention is geared towards the presidential election and whatever the candidates' policies and proposals may be. However, in order to get something passed, it all starts with Congress. To put it another way, the president can only sign what Congress passes. So when you look at the makeup of Congress with, as John mentioned, the Senate going solidly Republican and the House leaning that way, it's a question of when rather than if it gets called. Some House leaders have proposed fast-tracking tax legislation within the first 100 days of the inauguration. So between that, and I think it's important for everybody to recognize that a congressional election cycle is only for 2 years. So realistically, based upon past experience, Congress has 18 months at most to get anything passed because they'll be seated the first business day in January, and come the midpoint of 2026, they will be in midpoint of 2026, they will all be out campaigning in order to hopefully plan for their hopeful reelection going into the last 2 years of the president-elect's term. So anything we'll see will happen fairly quickly. Josh?
I just want to point out that it's important to keep in mind the rules that the House and the Senate have to deal with in terms of making tax legislative changes. Specifically, we've got the Pay-As-You-Go Act, which was implemented back in 2010, which basically says anytime the House or the Senate wants to cut taxes, they've got to cut spending proportionally. That they're not supposed to be adding to the deficit. So as we look at the tax bills that are out there that will be addressed in those first 100 days, they've got to be very careful to make sure that they're balancing the budget as they move forward. And then on the Republican side, you've got what are called the reconciliation rules. And basically that's, whenever the Senate is voting on budget proposals, there's a rule called the Byrd Rule, which essentially allows them to act with a simple majority and not having to go over that 60-vote filibuster limit. But in order to pass a bill under that Byrd Rule with the simple majority, the rule is that they can't increase the federal deficit beyond a 10-year budget window, which is how the Tax Cuts and Job Act was passed back in 2017. We're going to be talking about the Tax Cut and Jobs Act a lot today, also known as the TCJA. And so that was passed, but as a result of that 10-year window of not being able to increase deficits, the TCJA was set to sunset as of January 1st, 2026. And so, we'll be talking today about the possible extension of those and what that will look like from a tax perspective.
That's great. Thank you for both Rich, Josh, your perspective there. So let's dig into the Tax Cuts and Job Act a little bit more. So it was initially passed in 2017, implemented in 2018. Obviously, a very comprehensive tax bill that affected both personal tax planning, corporate tax planning, estate planning as well. Josh, do you want to cover a little bit about how it affected personal tax planning?
Well, on the individual side, we saw a significant increase to the standard deduction. For 2025, that standard deduction is going to be $30,000 for a married couple, $15,000 for an individual. And what that meant is that essentially a lot of people that might have itemized their deductions before now are limited to just taking that standard deduction because they don't have the expenses necessary to meet that $30,000 threshold. One of the key reasons for that was because of the SALT, the state and local tax limitation of only being able to deduct up to $10,000 of your state income taxes or state real estate taxes, which we may see a change to that in the next year as Congress takes up whether or not they're going to continue the TCJA.
That's great. And Rich, you want to talk a little bit on the corporate side?
Sure. No, it's interesting. The SALT cap had an impact not only to individual filers, but also individuals who have an ownership interest in flow-through entities, such as a partnership, LLC, or S corporation. For those watching who are unfamiliar with such entities, these are businesses where the owners make an election to have the company's profits pass through to their individual returns, irrespective of any cash distributions they may receive. So by imposing the SALT cap, these business owners were really under the gun a bit when it came to getting a federal benefit for the deduction of state taxes. So what a number of states have done, and I believe the count is up to somewhere between 35 and 38, the states have put in a system called the pass-through entity tax, or PTE. And what this tax does, it allows a corporation for state tax purposes to assume all liability for state taxes, pay them at the entity level, and claim a deduction on the entity's federal return, thus restoring the ability of the individual stockholder or LLC member to receive a benefit for those state tax payments. So individuals who are involved with such entities, they would still declare the income on their state return, but claim a credit for the PTE tax paid at the entity level. If the SALT cap completely goes away, many states have it written into their statute that the PTE will go away as well. If the SALT cap gets raised, which has been proposed, it'll be a bit of a win-win for everybody, and that business owners with an interest in flow-through entities will still be able to receive the benefit, while other filers, wage earners, retirees, what have you, living in high-tax states, whether it be income tax or property tax, will get some relief if they're able to itemize their deductions going forward.
Right. On that, Rich, I just wanted to note that, previously there was, in essence, a marriage penalty on that SALT cap in that, individual filers got a $10,000 cap, but married filers still also only had that $10,000 cap. So we might see, married going up to $20,000. And I also just wanted to note that, as you're thinking about whether or not you're going to itemize or take that standard deduction, there's a planning opportunity there to say front load your charitable deductions into all in 1 year to get you over that itemized cap of $30,000 on the standard deduction. And if you wanted to hear more about that, I would encourage you to go back and listen to the individual tax webinar and a piece by our own Jonathan Bloom and Dan Seaman.
Great. Thanks, Josh. I would add on the business side, sticking with flow-through owners for entity owners for the moment. There was also what's known as the Qualified Business Income Deduction, or QBI. And what QBI allowed was for owners of flow-through entities to essentially exclude 20% of their K-1 income or Schedule C income in the case of a sole proprietor from income. And the whole reason for implementation of this deduction is that where the top individual tax rate is 37%, the QBI deduction effectively lowered that rate to just under 30% for flow-through business owners. And the Small Business Association is really pushing hard on that to be extended going forward in any new legislation. When it comes to tax rates, the corporate tax rate under TCJA was reduced from 28 to 21%. And interestingly enough, unlike the reduction to individual tax rates, the corporate tax rate was made permanent irrespective of what happens in the coming Congress. And that would have been the case, again, regardless of which side won. So that's something to consider as well. And we'll be talking a bit about C Corps later. Other business provisions that that will be extended or look to be extended under any new law would be a restoration of the full deduction for bonus depreciation. As originally enacted, it allowed companies to deduct 100% of their fixed asset or building purchases for federal income tax purposes. And over the last couple of years, that has slowly been phasing down as part of a schedule built into that law. Similarly, for manufacturers or startup companies that incur a lot of research and development costs, whether it's software, medical device, pharma, what have you, starting in 2022, all companies were required to capitalize their R&D costs. Prior to 2022, companies had the option to deduct or capitalize, and that decision was made on a case-by-case basis. Getting back to Josh's comment about how you pay for a law, the requirement to capitalize was put in as a revenue offset to the original legislation, with the goal being, and everybody thinking that by the time 2022 came around, that this law would be rescinded. Congress tried on many occasions. At 3 points in time, it was the language to eliminate the requirement was put into various proposals or enacted laws, and for whatever reason, it didn't quite get over the finish line. There were a couple of other areas from TCJA, one involving how businesses deduct interest expense, as well as the tax treatment of companies that have overseas subsidiaries that are multinationals. And those rules apply to privately held companies as well as publicly traded and larger companies. And the rules regarding foreign subsidiaries are staying in place. The rules regarding interest expense will require some kind of modification going forward.
That's great. Thank you, Rich.
So I did see a question, Jonathan, on whether the QBI is set to expire in 2024. And I think, we can all agree that as of right now, it is set to expire in 2024, but we expect with the red wave that the TCJA will be continued beyond 2024. And that's really the what we're trying to get at today in talking about the TCJA, that, we expect Congress to re-implement it and continue it, maybe with some minor changes.
That's great. Thank you for getting to that, Josh. As I mentioned, it affected individual taxes, corporate taxes, and also estate taxes. So, Josh, do you want to talk a little bit about the estate world?
Sure. On the estate side, if you remember back in 2017 when President Trump was serving his first term, he campaigned on the idea of getting rid of the estate tax entirely. The estate tax is a 40% tax on the fair market value of your assets on your date of death, with an exemption. At the time when he was running, the exemption was $5 million. But instead of being able to get rid of the estate tax entirely, which was difficult because of the pay-as-you-go rules, what they did is they doubled the exemption to $10 million. It's grown since then from 10 million to currently 13.6 million due to inflation adjustments. And next year, on January 1st, 2025, it's going to go to 13.9 million. Because of the sunset, we were expecting, as of January 1st, 2026, that estate tax exemption would drop down to $7 million. And if you've been listening to any of my webinars over the last 3 years, you've heard me beating the drum saying you've got to do your planning now to take advantage of the $13.6 million exemption before it does go away. So we expect again that Republican-held House and Senate and White House will extend the TCJA, and so we'll see that exemption continue to grow from 13.9 million to however inflation takes it, but it's probably not going to be cut in half. With that said, it doesn't mean that you shouldn't be doing the proper planning. It makes sense to go ahead and take advantage of the $13.6 million exemption today to make those gifts, take the assets out of your estate so that all of the future appreciation will be out of your estate going forward. We don't know and we can't predict what's going to happen with taxes in the future. But the Democrats have always wanted to reduce the estate tax exemption. They were talking about bringing it down to 3.5 million. They were also talking about getting rid of the step up in basis and lots of other things that we can take advantage of today. So, with proper planning, we can take advantage of that, and you can still have access and control over those assets while still taking them out of your estate and getting all of that future appreciation out of your estate. And we would, encourage you to talk to your AAF CPA advisors about what can be done to do that today.
That's great, Josh. Thank you. Rich, did you have something?
I did. If we've learned nothing else over the years in observing elections, that the pendulum never stays in the middle. There always seems to be a wave going in one direction or the other. So while the red wave predicts very taxpayer-friendly rules in the estate tax area as it relates to the exemption and some of the other strategies that Josh discussed, and it's important to remember that 2 years, 4 years, 6 years from now, the pendulum can easily sway in the other direction, and that things that you do now will certainly benefit you by the time that the pendulum swings. Another consideration when it comes to estate planning, one tax, one non-tax, is that many states impose an estate tax as well, with exemptions far less generous than those that exist under federal law. So some people may wish to consider changing their domicile as part of their estate and income tax planning strategy. And I'm very carefully using the word domicile rather than residence, because changing one residence tends to involve an approach of form over substance, saying, well, I've got a new driver's license. I spent more than 183 days living elsewhere. A change of domicile requires that you really change your life overall to show that the place that you have moved has really become the center of your life. If you live in Massachusetts, have your family home and perhaps a vacation home on the Cape or in the Berkshires, if you sell your family home and relocate and retain the vacation property, that's helpful to you, but again, it's not a guarantee depending on which houses of worship you belong to and many other factors. So it's something to be watchful for. Changing one's domicile, it's a long-term planning strategy. So if anybody's looking at a large income event within 6 to 8 weeks, trying to claim a change of residency just beforehand may be looked at skeptically by the state revenue department of where you happen to reside now. The non-tax reason for implementing many of these estate strategies is that very simple. When an individual passes away, it creates a lot of grief and a lot of stress on the surviving spouse, children, and extended family members. And with the proper estate planning, you can bypass your estate can bypass probate as best possible. So at a minimum, your assets can get to whomever you wish to get them to as quickly as possible, and relieve that one stress component from anything else that occurs after death.
That's a great point. When I think of estate planning, I always want to stress proper titling of the accounts, right? And that means, if it's a taxable account, making sure that you either have a beneficiary or it's in trust. And again, to Rich's point, that can save a lot of hassle for your personal representative handling an estate. Josh, a question that I get a lot is, I have an estate plan. There's a layer of dust on top of it. How often do I need to update my estate plan? If I move out of state, should I update it? But what's your best advice on that?
So in general, I advise clients anytime you have a significant change in your life or what's going on in your life, you should revisit your estate plan, whether you're moving to a different state, whether you're getting ready to retire, whether your kids are graduating from high school, whether you've had another child. Any of those significant life events should prompt you to take a look at your documents and make sure that they're up to date and saying what you want them to say, especially if you're moving from one state to another. That's one of those factors that Rich talked about in terms of domicile. If I've moved to Florida, I should have Florida documents to go along with that. That being said, if on average, I would suggest that you take a look at it every 5 years, if there hasn't been any other reason to look at them previously.
That's great. Thank you, Josh. And I will say, all of those life events would also be a good time to update your financial plan. I couldn't resist the urge to throw that in there. So let's shift gears a little bit. So I know the mergers and acquisitions industry is near and dear to both of your hearts. So let's talk a little bit about that and I look forward to what's happening there.
Sure, John. I would say with regard to mergers and acquisitions, I would not suggest that anybody look to sell their business between now and the end of December, because the ramp-up period and the process of selling a company it takes much longer than 6 weeks. For those of you who are considering a sale of the company, the time to talk to us, whether it be for estate planning, structuring, or due diligence preparation, is 6 to 8 months before you think you really need to. Ramping up a plan to sell your company is a long-term process, and it involves all members of your advisory team, whether it be the three of us based upon our respective areas of expertise, your M&A attorney, your investment banker, and anybody else that will help get you the best possible deal over the finish line. With regard to anybody who has a sale in process and was looking to close by the end of 2024, due to concern about a blue wave and acceleration of tax rate increases into 2025, that worry it's as off the table as much as it can be, since we don't know exactly what Congress is going to do. There's talk about the capital gains rate being reduced from 20% to 15% for all individuals, irrespective of income level. But that's really the only open question in choosing whether or not to close a sale on December 31st or January 2nd. Much depends on how this affects the buyer and whether or not they're willing to go along with a 2-day delay, because a buyer may be able to accelerate tax benefits for themselves with a December close. So like anything else, it's part of the negotiating process. In terms of getting ready for a sale, things to look at involve preparing yourself for due diligence. And our outsourced accounting and financial group can help a company get its books in orders to withstand the rigors of due diligence. Within our tax department, we have a team specializing in state and local taxes that can help a company look at its income history, where its customers are located, to see if perhaps a company should have been filing in more states than it has been. And these are all things that come up in due diligence. So the reason I mentioned that 6 to 8 month threshold, it's really to help you get all your ducks lined up so that when the buyer and their due diligence team come in to ask the questions, that you are all prepared. The other thing where we expect, and this is non-tax related, we're expecting 2025 to be a very active year when it comes to M&A. First of all, the boomer generation that owns companies isn't getting any younger, and more and more are going to be looking to sell their companies if the next generation of the family it doesn't have the expertise or is just unwilling to take them over. More to the point, there's a lot of money sitting on the sidelines within family office and private equity investors. Much of it has been sitting on the side because of high interest rates. And given that there was a 0.5-point rate cut a couple of months back, followed by another 1/4-point rate cut last week, as well as chatter about there being an additional 1/4-point rate cut in December, we expect there to be a lot of activity in 2025. Josh, do you have some additional thoughts on this?
Well, I tend to agree with you, Rich, that if someone's thinking about closing and I'm the seller, I would prefer to delay it until 2025, where there's a possibility of lower capital gains rates, as well as being able to delay having to pay the tax until April of 26 to be able to enjoy the proceeds for an entirely another year, as opposed to if they close in December, they're going to have to pay by April. In the same vein, one of the issues that might be of concern or interest to our listeners would be what's called the qualified small business stock deduction. That is a benefit that became a lot more popular following the implementation of the TCJA and the reduction of the corporate income tax rate to a flat 21%. And what that QSBS, the Qualified Small Business Stock Exemption, does is it gives each shareholder of a C Corp up to a $10 million exemption on the sale of the stock in that company. And that's not a deferral. That's an elimination of tax of up to $10 million of gain, and that's per shareholder. So it's a very powerful and beneficial provision in the tax code. But what's interesting is when it was first implemented over a decade ago, originally it was only a 50% deduction. Then it became a 75% deduction, and now it's a 100% deduction. Previously, if we had seen that blue wave as a result of the election, we were expecting that possibly that QBI deduction might start to go back down again to the 75 or 50%. But today, with the red wave that we're seeing, we expect that QBI deduction to remain at 100%. And we would just point out that as you're thinking about selling your business, if you are a C Corp and you're selling the stock in that business and looking forward to taking advantage of that $10 million exemption, with proper planning, we can multiply that exemption out over multiple taxpayers. So instead of just having one $10 million exemption, you might have 2 or 3 $10 million exemptions to be able to take advantage of on the sale of your business. But again, just as Rich said, that's something that needs to be started months, 6 months, a year in advance, and can't be implemented once an LOI has been signed.
That's great, Rich. Josh, just a couple questions regarding QSBS. So, it's my understanding that it is now also applicable to Massachusetts state tax along with some other states. Is that correct?
That's correct. Most of the states have implemented QSBS. When it first came out, Massachusetts had limited it to a 50% deduction, and that was only for Massachusetts corporations that were being sold. Today, Massachusetts does allow for that 100% deduction up to the $10 million. And other states are similar.
That's great. And is this only for C corps? Is this only allowed for founder shares or any share or any owner of the C corp?
So again, it's just for C Corps, and it's just for shares that were issued to you directly from the C Corp. If I've purchased my shares from a third party or from another individual, then I'm not eligible for that QSBS. So I have to have received my shares directly from the company. At the time that I receive my shares, the company has to have less than $50 million in assets. And it has to be a qualifying business, and there's lots of rules on that. And I would just say, if you want to learn more about what is a qualified small business, I'll be talking about this tomorrow on our cannabis webinar, and would encourage you to tune in to that to hear more of those requirements.
That's great. Thank you, Josh.
And I would add into that for anybody who's working for a startup company and perhaps has received stock options, assuming the business qualifies under the abundance of qualifications that are required at the company level, an individual who's an option holder, those shares would qualify for QSBS treatment, but the 5-year period starts on the date that the option is exercised, as opposed to when it is either granted or becomes vested. So just for anyone who has the potential to cash in on a company via the holding of options, just bear that in mind.
That's
Yeah,
great.
unfortunately, with those option holders, they often have to wait until a sale transaction is taking place in order to have the cash in order to exercise those options. And if they're exercising it and turning around and selling it the next day, unfortunately, they're not QSBS eligible. They've got to exercise the shares and then hold them for another 5 years before they're eligible.
That's great. So, and I know that some of the QSBS stock is industry specific too. So I would encourage you, if you have questions, whether your company is eligible for QSBS, to reach out to your AFCPA's advisor.
Yeah, for example, attorneys aren't eligible, or accountant firms or architects. A lot of those professional advisory services or investment advising firms, the sale of those businesses are not eligible for QSBS. Of course, oftentimes they're not C Corps to begin with, and wouldn't be eligible in the first place.
Gotcha. All right, so let's change gears a little bit. So 8 years ago, when Trump entered the White House for the first time, he was a first-time politician, and it took some time for him to get acclimated and to make his appointments. Like most presidents, he was likely expecting an 8-year term, which in theory gave him more time to implement his initiatives, but at the same time appeal to his core enough to get reelected. This time, he will be entering the office as an experienced president for 4 more years, and has already begun announcing some of his appointments, including his announcement this morning of the creation of the Department of Government Efficiency, or DOGE, for those who are crypto inclined. This new organization will be headed up by Elon Musk and Vivek Ramaswamy, with an eye towards cutting government spending. It's a long way of saying he is likely to get started as soon as possible to implement some of his proposals. So let's take a look at some tax-related initiatives that Trump has talked about over the past couple of months. So some of these potential tax breaks, one that I'm sure applies to a lot of people, is the potential elimination of tips on restaurant and hospitality workers. Josh, Rich, one of you want to speak to that?
Sure. It's going to be interesting to see what passes here. And in looking at this and some of the other proposals that we'll talk about, the challenge is going to involve how businesses implement it. The benefits or the proposed benefits are clear to the individual workers. But if I'm a restaurant owner or I own a chain of restaurants, how do I track the tax that's going to be on the tax attributable to tips? Is it just going to be income tax related? Do I still need to withhold Social Security and Medicare taxes? What about state taxes? Will the states go along with this? Many states use federal income as their starting point for computing state income, both to the company and to the employee. If the tips are tax exempt and the employees still need to report them on the W-2, will the deduction be allowed? So there's a lot to see in terms of how that particular proposal gets implemented. Josh?
Well, I would just add, it's interesting because a tipped employee, traditionally gets paid a much lower minimum wage to go along with that. And if their tips don't equal the standard minimum wage, then the employer, the restaurant, has to make up that difference so that the employee is at least earning minimum wage. And so how would that work? If I, as a restaurant owner, am making payments out to my tipped employees to make up for the lack of tips that they did not necessarily receive, is that going to be income to the employee? And so in essence, is the employee going to be required to at least pay tax on a minimum wage W-2? And in the same vein, if they're not paying tax on it, do I get to take that as a deduction? That's traditionally how it goes hand in hand. Someone's got to pay taxes on it. So it's interesting to see. We'll have to wait and see what happens.
That's great. Another proposed tax break that President-elect Trump has talked about is the elimination of taxes on Social Security. Rich, do you have some perspective on that?
Yes, it's a very interesting proposal, and that prior to the mid 80s, Social Security benefits were not taxable. And at that time, the original law indicated that for individual filers with incomes above $25,000, 50% of Social Security benefits were taxable, increasing to 85% taxability when adjusted gross income reached $40,000. Now, except for a small tweak that occurred in the 1993, 1994, that time range, these thresholds have never been adjusted for inflation. So referring back to our earlier comments regarding the question of how do you pay for all of these tax benefits, if I were to predict, I'd ultimately envision a scenario where the Social Security benefits won't be made tax-free. However, the thresholds at which they become taxable would significantly increase, and or perhaps there would be some sort of indexing for inflation, just because the changes in the value of a dollar that have occurred over the last 30 years.
That's great. And I may have misspoken earlier. He's not proposing eliminating tips, eliminating the taxes on tips. So sorry about that. Didn't want to scare anyone. Some other proposed tax breaks that he has mentioned is eliminating tax on overtime, and in addition, eliminating federal taxes for first responders and military. So we'll see what happens with that. But again, across the board, those are going to be a reduction in taxes that are taken in by the U.S. So just like tax, before I move on, Josh, Rich, any other proposals that you wanted to mention?
I guess the only one I would mention is that, he has talked about allowing us to deduct interest on loans for the purchase of American-made cars. Again, that goes hand in hand with the administration's desire to force manufacturing to come back to the U.S. I find it interesting that it's similar to what the Biden administration did with tax credits on electric vehicles, that you could only get the tax credit for electric vehicles built and manufactured here in the US. But those are tax credits that they're now talking about getting rid of.
It's a great parallel.
And I would also say on that topic is, how do you define a car that was made in the US? Is it the Ford that's manufactured in Mexico, or is it the Honda that's made in Ohio? And even with regard to some of the cars that Honda, Nissan, and many of the German manufacturers make in the States, will there be another requirement as to domestic content? Or put it another way, are the parts being imported from Europe or Asia and simply assembled in the US? So there's a lot of definitions to be looked at in terms of how this would actually be written, never mind enacted. There's another policy that we briefly touched upon regarding the elimination of taxes and overtime pay. Similar to the proposal on tips, working with business clients, my question is, how would that be implemented, and would a corresponding deduction be allowed? Also, states will have a lot to say about some of these policies. Thinking about the federal implementation of bonus depreciation, many states decoupled from the bonus depreciation rule, requiring companies to utilize the depreciation rules that were in existence as if bonus depreciation had never been enacted. So similar to that example, we would expect the states at both the employer and individual employee level to have some thoughts as to how these rules would be implemented at the state level if they were passed.
I would agree, Rich, that it's going to be very difficult for these employers to be able to track everything, what's taxable, what's not. If we've got multiple states with different rules and the federal rules are different, I'm glad I'm not having to deal with that. I'll leave that to our SALT team.
Sounds like payroll providers would have their hands full as well. So let's again change gears a little bit again. So just like those tax laws and some of Trump's proposals, it's still too early to know anything for sure, and that includes when it comes to the economy. In the short term, we can see some things. We can see what the market is telling us, right? So short term, the stock market itself hates uncertainty. We always know that. They love a sure thing. So what we are able to see is that the market is relieved that it's over. It's not it wasn't a long drawn out fight over who won, no lawsuits like we saw 4 years ago. So there is some certainty there, which again is something that the market really likes. Similarly to 4 years ago, when Biden and Harris, when that presidency went final, we've seen a post-election market spike. Over the past week, we've seen the three major indexes hitting record highs. Now it hasn't been everywhere, but we have seen, a general upswing. So there have been some focused gains for what are seen as Trump-friendly categories. So this has included crypto, big banks, kind of financials in general, oil, and small cap companies. We've also seen some focused losses, especially in the green industry, specifically solar-based companies and EV companies, with the exception of Tesla, because we know the relationship between President Trump and Elon Musk. And we've seen those come back because of the potential removal of subsidies for those green programs. In addition, something that we're seeing from the market, right? When we see the market going up, that can be for a number of different reasons. There's always something going on. But the potential of deregulation is something that tends to be a positive for the market. We're going to see the idea of potential tax cuts, or at least taxes not going up for corporations, Another big one was the removal of some of the proposals by the Harris-Walsh campaign. These included removing the favorable long-term capital gain tax rates. That was putting a lot of pressure, on the market. And the other one that they were proposing was taxing unrealized capital gains, which again probably would have been a logistical nightmare to get that accomplished. But it's still the market would see that as an upswing to removing that potential. So that was the stock market. On the other side, there's the bond market. So what the bond market seems to be telling us is there's a potential for more inflation ahead. On the first day after the election, interest rates on the 30-year Treasury rose by the largest margin in over 2 years. So this can also be a result of the recognition of the deficit in our country continuing to grow, and the policies that have been proposed could potentially add to that number. So what does that look like? So some of these initiatives, there's been a lot of talk around tariffs. So Trump has proposed a 60% tariff on China, a 25% tariff on Mexico, and about a 10 to 20% tariff everywhere else. So Budget Lab at Yale did estimate that would initially drive up consumer prices about 5.1%. So the idea behind these tariffs would be to increase tax revenue to the country and push more business and manufacturing into the U.S., which Trump seems to be very passionate about. It's yet to be seen what lasting effects these tariffs and these policies will have on the economy, the deficit, and the end consumer. But again, we'll see that down the line. I would say as a takeaway, long term, it's tough to see how this government spending and new tax rates will affect the market and the economy, like I mentioned, which is why it's important to stay informed, keep within your risk tolerance, and avoid over-concentration in your portfolio. And as always, as I mentioned earlier, revisit your financial plan to make sure that you're on course to accomplish your short-term and long-term goals. Josh, do you have any takeaways that you want to discuss?
Well, John, you know me, I'm a trust guy. I got a trust for everything. And so again, I always want to encourage people to focus on their estate planning, be prepared, and get your estate planning done. There's a lot of good tools out there that we can use to reduce or eliminate that federal estate tax, as well as the Massachusetts or other states. Massachusetts did increase their exemption from 1 million to 2 million, but we're still the third worst state out there. So there's a lot of good planning that can be done to reduce the estate taxes on both the federal and state side. And there's also steps we can take to take advantage of what's called the step up in basis, which is, if you die owning an asset, your heirs inherit that asset with a basis equal to the fair market value at that time, which can eliminate a lot of built-in capital gain. And there's good planning out there that we can take advantage of today to make sure that your heirs or even you can take advantage of that step up in basis sooner than you might have thought otherwise.
Thanks, Josh. Rich, any key takeaways for you?
Sure. And I think I'd like to respond to that relating to a couple of questions that are in the chat, and one of which applies to whether or not there's any comprehensive list available to assist somebody with how to plan a move or how to plan a change of domicile. And I'll say there's a lot out there. A Google search will bring up more than you could ever hope to find. But I strongly suggest that anybody considering a move talk to us, because everybody's financial, lifestyle, and family situations are different. And to look at a list that you might find through a web search, it's a one-size-fits-all, and I've yet to encounter a client whose life and circumstances are one-size-fits-all. There's also a specific question regarding QSBS, and whether or not a company needs to make sure the language is in the company bylaws stating that it's QSBS. And I've never seen anything to that effect. It's all based upon facts and circumstances, the size of the company, does it operate in an allowable industry, and how and when are the shares issued to the individual, both in terms of that the form of the issuance and also the company's status at the time of the issuance. So, I mean, these are all great questions, and feel free to reach out to us if there's anything else you'd like us to discuss.
Rich, I would just add that I saw there was a question on whether inherited stock can qualify for QSBS, and it can. But what you have to keep in mind is it also matters that the date that stock was issued. If it was issued prior to the enactment of QSBS, then unfortunately you may not be eligible. Or if it was issued during the periods where it was just a 50% exclusion or a 75% exclusion, those limitations may continue to apply to you. And then on the domicile, I think you're absolutely right, and we've been involved in some of those domicile audits, and those states are very comprehensive in their audits. They'll ask for cell phone records to see where were your calls being placed from, and they want to see receipts, and it can be very difficult. And the Department of Revenue here in Massachusetts, at least, does not necessarily always play fair in terms of these audits.
Josh, a quick question on that inherited stock. So I assume that they're referencing C Corp stock. Would that be subject to a step up in basis anyway, or no?
You're correct. It possibly would have been eligible for the step up in basis depending on how it was held. If it was in an irrevocable trust, then they might not have gotten a step up in basis. There was also a question about ESOPs and QSBS. And again, I'll give a little plug for the cannabis webinar that I'll be speaking on tomorrow, where we'll be going a little more in depth into ESOPs, employee stock ownership plans, their benefits, and the taxability to the shareholders of a sale to an ESOP, including using QSBS.
That's great. Let's see if there are any more questions in the chat here. I think that we have. Can you address?
Question on the final rules on inherited IRAs and the 10-year rule and when the withdrawals need to be made.
I will say that that's not affected by the results of the election. Those rules on taxability of inherited IRAs were put out a few years ago by Congress. And what I would say is, it's really, and I don't know if anybody else here can see the question, but the question is, what are the rules for an inherited IRA? And basically it's, if I inherit an IRA, I've got to withdraw the entire amount from the IRA within 10 years of me having inherited it. There's lots of other factors that go into it as to whether or not the individual who originally owned the IRA had already started their required minimum distributions. I would just say it's very complicated, and I would again encourage you to reach out to your AAF CPA advisors to discuss those rules if that's an issue for you.
That's a great point, Josh. And I think that also opens up a great opportunity for tax planning as to when you are taking those distributions. If you're within arm's length of retirement, it might make sense to defer some of those distributions until you're in a lower tax bracket year. So there are a lot of ways to time the income to be most tax efficient. And again, a lot of it will be specific to your individual financial plan.
And I know for you, Jonathan, a lot of your clients, you work closely with them to think about Roth conversions. and the timing of that, because that can really be beneficial, especially if we're talking about having to take distributions down the road. If I've converted my taxable IRA to a non-taxable Roth, then I don't have those required minimum distributions down the road, and I can just continue to let that grow tax-free. So
Yeah, that's a great point. And it comes to income planning, especially if you have gap years with lower income, and again, trying to take advantage of some of those lower brackets when your income is down. And I will also plug what Josh talked about earlier, which was our individual tax planning webinar, where we get into some more strategies around that.